Okay, so really quick on the universal life insurance, right? So always think about universal policies just like a cash value policy, right? With a couple of differences. So inside of any universal or cash value policy, there's two parts, right? There,
Mm-hmm.
there's always an actual like insurance component, and then there is a cash component. Okay. So
Okay.
the insurance is on one side, and it helps if I spell it right, but also known as a death benefit, right? So insurance is over here. And then if that side's insurance, then this side is cash. Okay. Now, in a universal policy, because that's what we're focusing on right now. So universal, right? Inside of the insurance, whatever is your death benefit, if you die, your family gets that, right? So let's say this is a $500,000 policy, right? In the beginning, you have actually a $500,000 in life insurance, right? But over
Mm-hmm.
here on the cash side, like if we were going to go like, like straight across, like in the beginning, this is year like zero. This is the beginning. One, two, three, like 10, 20. This is years. Okay. And so your life insurance stays the same. The thing that changes in these policies is the cost. Okay.
Okay.
And that's what screws most people. And the reason that the cost is changing is because let's just say in year one, like right now for this policy, let's say the client is paying, I don't know, like 500 a month, because that's about average, right?
Mm-hmm.
Because it's remember in cash value and universal policies, on average for every 100K of coverage is about $100, right? And then, but the problem is in year one, like in the beginning, you have no money.
Okay.
In year like so this is year one, we opened it, now you've had it for a year. This coverage amount is going to stay the same, okay, all the way down. Year one into year two, almost no cash. The first 2 years of this policy, there will be almost zero cash built up into it.
Okay.
It's gross, right? So now we're going into year three, and coming out of year three, let's just say, because if this is 500 a month, how much is that annually?
Hold on. I have to do the math.
You're good. 6,000.
Almost 6 grand, yeah.
So 6,000 AP, right? So annual premium. So now you've got 500 a month going into this, and there's no cash after 2 years. Does this feel like a savings account?
No,
Does it feel like you're building any cash at all?
no.
No. And in the first 2 years, you've dropped friggin' 12K into this thing, right?
Yeah.
Now, they don't always go zero, but a lot of times it's zero for the first couple of years. Now, your life insurance at up until this point, the price has stayed the same. Okay. Usually in a universal policy for the first 10 years or 5 years, the life insurance is level term inside of this policy. But right here, usually at year 11, the cost is going to skyrocket and start going up.
Okay.
Now, inside of this policy, you have art. Okay. Art is not like our life insurance. Our life insurance is level. And so a level life insurance policy means the price never changes, right? That's the idea. So that this is ours, this is good, this is what you want. What art is annual renewable term. So if you have art and it's annual renewable term, every year it renews, do you think they're going to give you the same price?
No, because your age, goes up.
Exactly. So every year you get older, the cost of the insurance goes up.
Yeah.
So let's just say 20 years from now, you're 20 years older, right? But you've still only been putting in 500 a month. but you've got this annual renewable term. So now your cost for the insurance is going up. Okay. So
Mhm.
let's just say in the beginning, you were putting in, um, oh, I don't know, right? Let's say you were putting in 500 a month and it was giving you, like, the insurance was costing you like 100 a month, right? And then once you started actually accumulating cash, it was going over here to 400, right? That was in the beginning. So that's year 1 through 10. But now it's year 11, and now your insurance costs 150. But remember, you're still only putting in 500 a month. So now you're only putting in 350, right?
Mhm.
Let's go to year 15. Let's say by now it costs 250. Now you're only investing 250. Year 20, right? Now your insurance is going to cost like 400 a month, so you're only putting in cash value 100 a month.
Got you.
Do you see the problem here?
Yeah.
At some point, the insurance, right? This 500K in insurance is not going to change if you died, but the cost of it will start to exceed your original amount. And so at some point, if you don't pay more for your monthly insurance, right? If you started building up cash over here, well, that cash over here has to come out to pay the bill.
Yeah. So I don't know. I mean, this is kind of like on the subject, but what is the point of a cash value?
That's a great question, right? So when we say we should help clients buy term and invest, right?
Yeah.
So let's back up a little bit. With the cash value policy, right? You're like ultimately trying to build up cash inside of the policy so that at some point you can borrow it,
Okay. So
right?
like a loan basically.
Yeah, you're giving yourself a loan. But remember, Skylar, when we have a loan, what do we have to do with a loan? Like when you take a loan from a bank, what do you have to do with it?
You said Skylar. Is Skylar in here?
Oh, sorry, Jesus, right, Lacey. I'm sorry.
Oh, I thought Skylar was in here. I was like,
No,
oh,
she had texted me and it popped up and it like my ADD kicked in.
oh no, you're fine. So you have to pay it back.
Yeah, so when you take a loan, you have to pay it back, right? And so where we would come in and say, well, remember in a whole life policy, whole life, right, is better than universal, still bad. But if we have a $500,000 whole life policy and we're paying 500 a month, like at what age will we have 500,000 in cash?
100.
Age 100, right? So
Mm-hmm.
do you want to be 100 before you can access your cash?
No.
No, right? And let's fast forward. Let's say 20 years from now, your death benefit is still 500,000. And over here in cash, 20 years from now, let's say you've built up 50 grand, right? Well, Lacey, if you die today and you have this policy, right? Do you
Mm,
think do you think Ryan wants a half a million or 50 grand?
probably 50 grand.
Really? You think he wants 50 grand instead of a half a million?
500. I'm sorry.
Other way, right? He wants more.
Yeah.
So who keeps this? Who keeps your 50K in cash?
The insurance company.
Does that seem fair?
No.
No, it seems gross,
Yeah.
right? So here's the other thing. You guys are like what, 23?
Yeah, 22, 23.
Okay, so this is where we would come in and we would say, look, we should be buying term and investing because what we would do with a client is we would take the same money, right? And I would say, listen, for the same insurance, if I can give you the same death benefit, right? Like God forbid something happens to you, your family's still going to get the half million, but I could save you a lot of money and we can start investing it for you. And I could over time make you more money. Would you rather have more or less?
More.
Right. So this is why we should buy term and invest. And here's why. Because let's do this, right? So here's the retirement calculator. It's just a compound interest calculator. And so I'm going to pin myself to the side over here. I think for the recording, it'll do better. So you're 23. right? If we were going to invest, well, here, I'll pull up an actual quote so people don't think I'm like making this stuff up. Well, I mean, it's important because like I could just make up a number, but I'll I'll make it exact. Because if you were going to open the same insurance policy and like I'll even assume that they would charge you a little less, but like on average, 100,000 in whole life, $100. Okay. So quick quote, you're 23, female. Well, let's just do a male. Like let's say this was Ryan's policy, right? For a 35-year term, for a half a million in coverage, right? $71 a month.
Wow.
Okay. $71 a month. So what we would do is we would come back over here and I would say, listen, Lacey, Ryan, if you were going to spend $500 anyway, right?
Mm-hmm.
500 minus 71 is 429. We're just going to put 429 into your Roth. We're going to use the same money and we're going to do that every month. And I'll even be super conservative and I'll say at an 8% rate of return.
Wow.
Now, I'm no math magician, right? Like I'm not special, but I'm pretty sure that 2 million bucks tax free at 67 is better than a half a million at 100, and I don't have to borrow this money,
Yeah.
right? If I get to 67 and I want this money, I'm going to take this money. You with
Okay.
me? Now watch this, right? And this is where it just gets bananas. Like 2 million bucks, right? Let's say at 67 you stop working, because if the half a million isn't going to be there till 100, right? Watch this. Because in most whole life policies, when you get to about 65, you generally stop paying,
Yeah.
depending on the age that you took it out. But you still don't reach your full face value until age 100. Watch this. Let's say your $2,098,754 is in that account, and we stop contributing at 67 because you stop working, right? But let's say you never touch it. Even if we shift it over and we make it like very conservative, basically like putting it in bonds and cash
Yeah. Wow.
at a 5% rate of return. Very, very, I mean, that's super conservative. That's like bonds, right? Even at 4%, watch, it doesn't matter. So again, would you rather have almost $8 million at 100 or a half a million that you still have to borrow? Now,
Probably.
when you get to 100, right, you win, right? You won the age lottery at that point, and now the money's yours. You don't have to borrow it. You just get it, right? You just get it back at that point. But I would still rather have almost 8 million than half a million.
And that's the Roth, right?
Yes, ma'am. So this is tax free, Lacey. Tax free, right? And so when you look at the blue page, right? So this is, if you scroll back up, this is the blue page that we use. Farther down in this PDF document is an example of buy term and invest the difference. Okay. This is buy term and invest right here. This example, right? They were a little more conservative on the cost because Mary's coverage was probably less than 200 for 200,000 because the woman is cheaper, right? So same money though, same $300, and now we gave them double the life insurance, but saved them almost, well, over $200 a month, and then we just invested it. And again, look, at 65, they've got almost the 400K in cash that they would have had when they reached 100 over here. And you don't have to be dead to get it. You don't have to borrow it. And
No, 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 no. Not wrong.
if one of them dies,
Okay.
right, the beneficiaries get both.
Got you.
So now, God forbid something happens and the life insurance is still in force, well, you get the death benefit. And whoever is the beneficiary on the retirement account, we roll that over to the beneficiary. Now you get both, right?
Okay, so that puts it